Okay, let me open the floor to some people from the audience who want to make comments. Katarina, do we have a microphone or we have to use this one? I guess you. Yeah, why don't you come then to the...
Since I sit up here. So thank you very much, first of all, for this very interesting introductory remarks and discussion that we've heard so far. I'm just wondering whether we should think a little harder about the ways in which we might come to some kind of understanding how to govern the global financial system that actually departs from our Bretton Woods system and departs from the notion of having to come to a collective agreement. I fully agree that given the structures that we have and the multiplicity of interests, we will not have a collective agreement. But we could also have some not so disparate outcomes by, for example, mimicking. I mean, one thing that we're seeing right now, which I wouldn't say is so bad, and I also don't think is so protectionist, is that increasingly countries are rethinking the notion that we should leave, for example, the banking regulation to the home country regulator or accept the European passport system without qualifications. But countries are saying host countries should be able to control that as well. And it's interesting that both the UK and the US are the first movers here. So the UK has announced that it will impose liquidity constraints on foreign branches. And that's actually possible even under European directives. The US, in the legislation that was just published two weeks ago, has announced that it will declare foreign banks to be tier 1 companies that might be regulated by the US if they have significant operations of one sort or another in the United States, and if their asset structure or exposure to particular liquidity will endanger the US financial system or its economy. So to the extent that countries are coming back and saying, well, okay, home regulators might regulate the entities, we regulate our system, and other countries make similar moves, we might have actually much better allocation of risk assessment and risk judgment and regulation than we had in the past. And that might help us actually to use financial regulation at the country level, at the host country level, using effect-based regulation essentially to establish a better regime. So my question is basically, shouldn't we just move away from this notion we can get something done only through basically common agreement, sort of a Bretton Woods type of new arrangement at the global level, and shouldn't we look more at actually this modeling through that the European Union has showed us to do for the last 20 years?
Stephanie? Yes, I guess we have to. Okay.
Thank you very much. I actually do agree that very much with Joe that you do need common standards, although you can make progress through, I think, host country regulation. But I wanted to ask a broader question. Haven't the developing countries actually acquired a lot more power that you were implying at the end because of the holding of reserves that they have? And can that power not be used, and I think it has already a little bit, to precisely demand, as Adam hinted a bit, a better regulation from the developed countries? Because if they, for example, the Chinese say, look, if we want to continue investing in US Treasury bills, we're very worried about your financial system, or we're very worried about the dollar, and if you don't do certain things, we'll just have to switch our assets. And so I think that does actually give quite a lot of additional leverage, perhaps, for change in a different way than things happened at the Bretton Woods moment. Another question I wanted to ask is, listening to Joe, he explains very clearly how banks were so powerful to block progress on regulation in the United States. But it's quite interesting, I think, that in the UK, where the financial sector is at least as dominant, the cities as a proportion of the economy even bigger than the US, at least the voices from Turner and Mervyn King, particularly recently, have moved much more in a pro-regulatory or pro-Tobin tax and so on perspective. And why is that? Why is that difference? And why, like in the 30s, the anger isn't better channeled here towards more regulation and towards constraining the power of these very big banks, and how could it be? Thank you.
Yeah, Akbar, and then, the back.
Yeah, it seems to me that excuse me, a lot of this pessimism we've heard is based on a really fundamental optimism, which is that the crisis, the Bretton Woods moment has passed because the crisis has been dealt with. So, I mean, the question is that really the view of the panel, that in fact there won't be a reasonably quick recurrence? Underlying it, of course, there will be eventually a recurrence of the crisis if you're right, in the sense that if there is no significant reform, which seems to be the general consensus. The question is, when will this come, the crisis, if there isn't a significant reform? Thanks.
Okay, yes. In the back, yeah, why don't you come to, we need that. Okay, and then you, and then we finish.
Two effects of the failure to advance real reform in the financial sector and in global monetary policy. First, on the domestic competitiveness of the U.S. economy, I think I think that will have really deleterious effects. And I wonder if you could comment on, I think, what I call Simon Johnson's hypothesis, the effects of the United States devolving politically, essentially to an oligarchy, with all this consensus from economists, social scientists, with, I think, a diffuse but somewhat public attitude that things need to be changed in the financial sector. What is this effect on domestic American economy and its reverberations throughout the world? And second, on a corollary point, what are the effects of the continued deadlock in financial and monetary negotiations on things like trade talks, climate talks, proliferation talks?
Yeah, there seems to be a consensus among economists that the U.S. Unemployment situation will recover within 4 or 5 years. But where is that consensus coming from if, in fact, the public treasury is underwriting these dangerous financial speculation, and the politics in Congress is against going into deeper and deeper debt to pay for things like reconfiguring our national energy grid and so forth? Where are the new jobs going to come from?
Thank you. So let's go through a last round of comments by the panelists.
The question here was one that struck me in particular. We all seem to be agreed that the Bretton Woods moment has passed, that the opportunity for a really significant transformation and reform of the system has passed, and it has to do with the decline of the feeling of panic since a year or 18 months ago. Does that mean that the crisis has been solved? Well, it depends on what you mean by solved. And I think what we have done is to achieve enough limited success in containing the crisis that people now are breathing a sigh of relief. One of the useful aspects of crisis is that it often can become a catalyst for significant reform. In East Asia, for example, the crisis in 97, 98 was a significant catalyst for a movement toward financial regionalization, symbolized best by the Chiang Mai initiative. But it doesn't always happen that way. Sometimes what happens is that the crisis simply leads to actions that are what the psychologists would call like parallel play. Where different countries are all in the same boat, they all act in a way that seems coordinated, but in fact is unilateral. And the result is that as soon as things ease up, then they go their separate ways once again. And I think that that's where we are right now. Mr. Ocampo spoke of the remarkable coordination of central banks. I don't think that was coordination, though there was some coordination, I think, between the Fed and the Bank of England. Perhaps I'm wrong. But what it was a situation in which all central banks felt they needed to do for their own economies things that seemed to be coordinated. But the fact is that they were acting separately rather than in any kind of coordinated fashion. I think that what we have is a good example, to go back to the phrase used, of muddling through. We've muddled through. This is by no means anywhere near a first best outcome. It's not even a second or a third best outcome, but it's going to be stable enough till the next crisis.
A few points really quickly. The characterization that we don't think anything's going to happen, and this gentleman talking about crisis, I mean, maybe I was completely unclear, but I thought I said pretty explicitly that I thought one of the reasons we are going to see something actually on the financial front was because I did think there would be a recurrence of financial problems. I was pretty explicit about that. I've been on the record on that for a while. So, yes, your characterization of that sort of duality is there, but I don't think it's a fair characterization to say none of us were saying that. We were. Going back to Stephanie's point, I think that's right, but I think it's important to distinguish between having reserves per se and having investors. So if you're Chile, if you're even India, you can have a relatively large share of reserves compared to your GDP, but as long as you're just sitting on them as reserves, you're sitting on them as a pile of gold or a pile of dollars or a pile of dollars, euros, and yen, actually your influence isn't that great. It's when you're Singapore and you have the GIC, the Government Investment Corporation, or you're Abu Dhabi and you have ADIA, or you're the Chinese Investment Corporation, and you can say, well, I've got X hundred billion to invest, and I'd rather, because the U.S. has chosen to go down this path. It seems to me I don't really view that as attractive as putting my money in some other country. And I think there's an important point from empirical economics. Linda Goldberg, who's at the New York Fed, among others, has pointed this out. Many people have pointed this out, but she did some particularly nice work on this. You really get, and Professor Campbell knows this, you really get problems and change in countries when it's the domestic financial people who say, I don't want to be here anymore. It's not just when other people externally say I want to reallocate, it's when there's capital flight. Now, I'm not saying there's going to be capital flight from the U.S. in the immediate future, so no one should write that down or quote me as saying that. But I am, for all this talk about the power of the banks, if the big banks and the big investors are as selfish and self-interested as we would expect them to be, there could come a point where, for all their talk, with one hand they're insisting on having deregulation and bad supervision in the U.S., on the other hand saying, well, hell, I don't get any good returns here, I'm going to move the money abroad. And that would not be a sustainable situation, and that leads to the kinds of pressures you're talking about. Final point, there was someone who made reference to the British example. And I would not, in my current situation, be allowed, nor should I comment on British politics, but I would just reaffirm the facts, which goes with the idea that I said that I'm a little more optimistic that there's political traction on the financial side than on the macro side. In the UK, Adair Turner, who is the head of the Financial Services Authority and who used to be head of Merrill Lynch, has written and said some very strong things about regulation. Mervyn King, the governor of the Bank of England, gave a speech recently, very strong on regulation. I just gave us my first speech as an NPC member a couple weeks ago. I came out pretty strongly for regulation. There are other people in the public debate, former Bank of England people like Charles Goodhart and Willem Bouder and others who are out there doing it. And that is juxtaposed. Yes, it is a fact that in the UK, financial services made a much larger share of GDP than in the US. So let us at least take hope from those facts that such things can occur.
Okay. Joe?
Okay. A lot of good questions. Let me first take up the point that Adam said in the beginning, that institutions are endogenous, and one of the consequences of the absence of a good alternative reserve currency and the dollar being so risky is more and more money will go into sovereign wealth funds, and they will be exerting pressure. And that will be a problem in the United States and other countries because there will be some unease about the magnitudes of government funds, sovereign wealth funds coming in. The issue has disappeared, but I think it will come back. I agree that given there is both a micro problem and a macro problem. The micro problem is that we haven't fixed the banking system really, If you look at, there are a whole host of problems we haven't talked about, commercial real estate. And so I think there is a reasonable probability within the next few years, and we even within the next year, that we will have another big bump. The macro problem is, I think, a more persistent problem, and that is that what had sustained the U.S. economy before the crisis was a bubble. There are some reasons why aggregate demand has been weak, but the fact is that there is nothing on the horizon. It's always difficult to forecast, and the optimists say something will come, we can't tell what it is, but there are some good reasons to think that the U.S. economy will lack effective aggregate demand, and so will the global economy. And so that means going off 3, 4, 5, 6 years, it's hard to see a robust recovery. And I maybe I'm optimistic over that the outrage that we've all waiting for and we haven't seen may start to fester, but it isn't always clear that it will be a constructive outrage as opposed to a rather negative one that we saw in the Great Depression. So I mean, I think any of us who are, have to be worried about that possibility. I think the point that was made that there's a lot of what was called parallel play is exactly the right description of what has been happening in the G20. They said, oh, we all have to get together and have our stimulus. And what they all did is to have their own stimulus. And you could see it was all driven by domestic politics, and they all they show their little stimulus to each other, and then they all go back and say, "Aren't we great?" And so there'll be a lot of that going on, but that fits in with Katrina's point. I think in some areas you don't have to. I agree. You don't need to have complete uniformity. On the other hand, the principle that had underlay much of financial globalization was that there was to be unfettered financial integration. Now, I think that it was a flawed concept in the beginning. It was a concept that works if you believe you don't need regulation anywhere. If you don't need any regulation anywhere, the fact that there isn't regulation anywhere doesn't bother you. So, in a sense, the liberalization movement across borders was consistent with the notion that we don't care because we don't think we need regulation. Once you take the view that we need regulation, then either you go to a single set of principles, or you go to the system that we will go to, where each country will go after itself. I think we really will be doing that, and I think that is a very big change in the way the global financial market works. I don't think it's going to be the end of the world, but it is a very. I mean, we shouldn't underestimate the change that this represents from the model of financial market integration that prevailed 10 years ago. I think the point that was made that the final point I want to make, I mean, 2 points. One, I think Simon Johnson is right about his characterization, and I think it's very interesting because both he and I have seen this problem in developing countries, and when we see it in the United States, it makes us feel particularly unhappy. So that Simon Johnson was the effectively chief economist of the IMF, and I was at the World Bank, and you go around and you see the role that you see a lot of financial crises, and you see in a lot of the financial crises, the financial oligarchy uses the turmoil of the crisis to really get more money for themselves. And it's sort of a standard pattern. And so what we're seeing here is, I would say, a standard pattern, but you would hope that we would do better. And I think that it's obviously very disturbing, and I think over the long run will have or at least could have very profound political consequences for the evolution of our political process. And finally, I think now to go back to, I hate to end on a note of pessimism, but the difficulties of global governance, I think, are highlighted by the fact that we are almost stymied in every area where something important is going on. Not every area. We've had some successes. But climate change, I think the pessimism about Copenhagen is pretty deep. The trade talks have reached a deadlock. So, in fact, it goes back to some of the things that, effectively you were saying in the beginning, when it turns out that there are conflicts of interest, and I think the conflicts of interest are as much internal as across countries, it becomes very difficult. Even when there's a consensus among, you might say, the policy wonks about what should be done. When there are these big, and almost in every case, distributive issues domestically at hand, I think it's very hard to get global to get a global agreement.
Yeah. Well, let me perhaps make 3 or 4 comments. But there seems to be a consensus that at least the Bretton Woods moment is past. I personally think there was I really think there was never a Bretton Woods moment in the last couple of years. I don't see it come at any stage being a desire for fundamental reform. Now, I find interesting the differences of opinion on the macro versus the micro or regulatory issues, that have been expressed. I'm actually a bit more optimistic. I guess I'm on Adam's side on that there will be some financial regulation that will make sense. But I really think the macroeconomic issues are going to continue to be tough. I mean, I guess from the point of view of U.S. and this issue of the fluctuations of the dollar are not seen as a major problem. I guess they will be increasingly seen as a problem in Europe. Maybe when the euro is 160 or 170, there will be some call for deeper reforms. On my side, I really think we're seeing a very lousy problem going on, which is this, in a sense, this carry trade that is going on now, with the emerging markets, driving crazy monetary policy in emerging markets. I think it's a real major phenomenon, which maybe Brazil took a first decision that is going to become more broadly. So perhaps this is leading to fragmentation of markets. I don't know what is going on, but what is going to happen. But I really think the discussion is going to be deeper. And in the we had actually another meeting on the global reserve system a few days ago, and actually, if I can sense a consensus there, is that one of the major problems facing the international economy is that nobody wants to run a deficit of the external account. Now, a world in which everyone wants to have a surplus or a balanced external account, including the United States, is not a viable world, as we know. So I think that perhaps that's a sign that there is something more to come on the global macro side that may be leading to action. And finally, I think the worst note of pessimism I hear on the table is the sense that the G20 is more or less a useless invention, because after all, it did not increase participation really. There are some emerging markets that are probably should walk out because they have no voice anyway. That the minimum common denominator seems to be the rule, so that anything that the U.S. says should not be in the agenda is not in the agenda. So that it has not even improved over the G7 in that regard. Anyway, those who are outside are unhappy. Because they are not on the table, and that the process, is an ad hoc body that is going to probably be even more ad hoc, as there are decisions by I don't know exactly whom to maybe include other countries on the table. I mean, yeah, the Scandinavians are right, but there is no poor sub-Saharan Africa country on the table. I said, were it not because the Netherlands pushed itself into the G20, there would be no country that met the 0.7% target of aid. I mean, we can continue with the problems with the G20. So maybe, just by self-designating itself as the major mechanism of global economic cooperation, which is what it did in Pittsburgh, we actually got into not a very good one. Okay, thank you. Let me just say an applause for the speakers today. Thank you very much.